Where should you invest your money to maximize your long-term investment returns? Well, here's the answer.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund.
That right there is Warren Buffett. He's a US investor that's amassed a wealth of $112.7 billion. And he did so by having sole exposure within his investment portfolio to the US stock market. And he recommends that the average investor should do exactly the same thing. So today I'm going to share with you guys why I personally invest in the S&P 500. And I'm going to share how much I have invested too. And I'll also share some of the downsides that aren't usually talked about from investing in this popular fund. But before we do all that, guys, my name is Mitch. I post all kinds of videos about stock market investing. So if you do enjoy content like that, be sure to subscribe to the channel. With that being said, let's begin. So my exposure to the S&P 500 is through something called an exchange traded fund. And the fund that I actually invest into is the Vanguard VUSA S&P 500 ETF. In my Vanguard account, I have £11,279 invested with unrealized profits of £5,941. And over on Trading 212, my investment value stands at £6,606 with an unrealized profit of £135. So from a near on £40,000 investment portfolio, I have roughly about 43% allocated to the S&P 500. But why? Well, let's talk about the first positive thing about investing into the S&P 500, which is its long-term performance. The sole purpose of investing your money is in order to obtain a return on that investment. And ideally, we want the highest rate of returns possible, which is why I invest in the S&P 500 because historically speaking, it's done pretty well for investors. A study done by McKinsey & Co shows that over the past 25 years, the S&P 500 has provided a nominal investment return of 9% per year. And when accounting for inflation, we're still talking about a real rate of return of 6.8% per year. Now, what that means in practice is if you would have invested £250 per month for the past 25 years, achieving a 6.8% return on investment, you would have ended up with a portfolio value of £197,585. And that's £200,000 in real terms. And actually, when you account for inflation too, the actual total value of your portfolio would be £282,632. Now, of course, I must say here that past performance isn't always indicative of future results. And just because the US stock market has performed pretty damn well in the past 25 years, doesn't necessarily mean it's going to perform just as well 25 years into the future. But I must say, I'd rather have my money invested in a fund that's provided between a 6.5 to 7% return on investment over the past 200 years rather than have that money sat in cash in a bank account getting eroded by inflation every single year. So with that, it gives me much more confidence to continue investing into the US stock market because I know it will pay me dividends, figuratively and quite literally too, over the long term. The second reason to invest in the S&P 500 is that it removes the guesswork. One of the hardest things about being an investor is when you take individual stock picking into your own hands. Yes, the greats like Warren Buffett have made an absolute fortune by doing so, but your average investors like me have had some pretty mixed results over the past couple of years. I've had successful investments in the likes of Apple, where I've made an unrealized profit of about £2,500, but I've also had poor performing investments like Palantir Technologies, which is down just shy of £1,000. And whilst I certainly don't want to make too much in the form of judgments on the short-term performance of my investment portfolio, I think what's important to observe here is when you look at investments over a long period of time, the performance of individual companies certainly changes. Interestingly, here are the top companies by market capitalization 25 years ago. It's dominated by Ford and General Motors, and Tesla is nowhere to be seen. The only tech-related firms within the top 20 are IBM and AT&T, whilst Microsoft are ranked 172nd. And Apple wasn't much more than just a penny stock at 16 cents per share. The point that I really want to try and labor on here is that the top 10 companies back in 1997, none of them feature in the top 10 list in 2023. Companies certainly come and go, and the top 10 25 years from now, as much as this might blow your mind, probably won't be the top 10 companies that we see today. And there is of course a probability that some of those companies won't even exist at all. However, the power of investing into something like an S&P 500 is that it continues to give you exposure to those top performing companies in the United States of America. The reason being that the list within that S&P 500 is actually reviewed on a quarterly basis, which means the worst performing companies drop out of the index and the best up and coming companies enter into the index. So therefore, you only ever have exposure to those top performing companies, which in my opinion is a hugely powerful investment strategy in an ever-changing world. The third benefit is diversification. As I said, investing in the S&P 500 gives you exposure to those top 500 companies. And those companies are diversified amongst many different economic sectors. We've got tech making up the biggest portion of the index with just over 26.1%, followed by healthcare, financials, and consumer discretionary, amongst others. And the reason why I think this is important is because it creates stability in ever-changing economic circumstances. When there are tougher times, when we're perhaps facing into more recession risks like we are right now, then you've got exposure to consumer staples investments, which are a little bit more recession-proof, versus when we're in a period of contractionary monetary policy and the financial sector might perform slightly better thanks to rising rates. Or even perhaps during good economic times when everybody's spending their money on the latest pieces of technology, and the tech sector certainly will perform very well. And whilst not all sectors within the economy will perform the same at any single given point in time, because you have that split when some areas are falling down in value, other areas will be going up in value, which hopefully will create more stability within your investment portfolio. So as John Bogle, the founder of Vanguard, once said, "Don't look for the needle in the haystack, just buy the haystack." So they are three major benefits from investing into the S&P 500, but now let's dive into some of the downsides and perhaps some of the risks that make it a little less favorable. Starting off with the first negative, which is that there is no global diversification. Diversification in itself is a little bit of a contentious topic. I've just argued that the fund itself is diversified, so how can it now be on the list of negatives as something that's not diversified enough? And that's because diversification comes under many different headings. You've got time diversification, geographical diversification, and asset class diversification. And because you've got all of those options, there's certainly no one-size-fits-all approach. In actual fact, the likes of Warren Buffett will actually argue that diversification is a bad thing. He's been quoted saying that wide diversification is only required when investors do not understand what they're doing. But the fact of the matter is, everybody is different. Let's say that you're a UK investor, the chances are that you might want some exposure domestically to UK markets, but equally you might want to also tap into some other geographical locations, perhaps over in Europe or America, in order to spread that geographic risk. As a result, it means if the US performs well, but the UK performs poorly, at least you've got one part of your investment portfolio going up in value, whilst the other part might not be performing all too well.
I like it.
So of course, having all your eggs in that US stock market basket, so to speak, doesn't give you that broad scope of diversification that many investors look for. The second negative aspect is the exchange rate risk. Now, when you're buying foreign investments like I am when I'm investing my Great British pounds into US-based companies, it exposes me to fluctuations in the exchange rate, which of course can either be favorable or unfavorable and can massively impact my overall investment returns. The reason being, when I'm investing into an ETF like the Vanguard VUSA S&P 500 ETF, whilst its unit prices are actually quoted in pounds and pence, the underlying value of those investments are fundamentally denominated in United States dollars. And technically, if I were to buy those shares on an individual basis, like Apple as an example, I would, or my broker would, exchange my Great British pounds into United States dollars and invest those dollars into shares within the company. And the same process goes for selling too. If I were to sell my shares, they'd be sold into United States dollars, then converted back into Great British pounds, which exposes me to the exchange rate difference at any given point in time. And the reason why I call out this exchange rate risk is because exchange rates can actually change quite substantially. For example, just this year alone, the United States dollar has actually lost about 3.8% of its value against that of the Great British pound, meaning it would have been more favorable for me to actually hold Great British pound denominated investments or equities as opposed to that of US based equities, unless of course those US stocks outperform from a stock price growth perspective. But with that said, it's certainly a far more advanced approach when it comes to strategizing around your overall investment portfolio. And I think as an overall caveat to this, one thing I kind of will loosely say is that exchange rates swing around in roundabouts. Sometimes the US dollar is more favorable, and then other times the Great British pound is more favorable. I think the most important point to make here is that as long as the underlying asset that you're investing into remains sound, then that's the most important thing. The third and the final thing to call out is increased volatility. Now again, this might slightly contradict what I said a little bit earlier on in the video, but of course volatility is relative to the other asset classes out there, and I think it's probably quite sensible for me to call out at this point that investing solely into the S&P 500 is a higher risk, higher reward investment, and in actual fact it's ranked 6 out of 7 on the Vanguard risk spectrum, and that's because it's got a sole exposure to the equity market, which by definition has a higher risk profile than some of the other asset classes out there. So naturally I think it's super important for everybody to understand your overall risk tolerance and risk appetite, because that will go on to dictate your overall portfolio makeup. And of course it doesn't necessarily mean that just investing into the S&P 500 is a bad thing. It just means that you might want to consider other asset classes out there in order to potentially reduce your investment portfolio's volatility and the kind of risks that you're exposed to. But fundamentally, like Warren Buffett said, I certainly agree that investing into something like the S&P 500 is one of the best investments that your average investor could make. But they're just my thoughts, so be sure to let me know yours down in the comment section below. But if you're interested in other investment strategies, particularly making money through dividends, then be sure to click on that video next. And with that being said, see you over in the next one.